Hey, what's up everybody? It's your mortgage expert, Brian McCauley. So are you buying a house and you keep hearing this term closing cost? You're confused on what it is, how much it is, and who's responsible for it? Stick around. In this video, I'm going to teach you everything you need to know. So listen, the Dallas housing market is turning a corner quickly. It went from being ice cold, now it's lukewarm. But as buyers are out there making offers on houses and starting to shop again, the word closing cost is coming up and people are confused on what this means, how much it is, who's responsible for paying it, how do I calculate it. So what I want to do is I want to walk through a few specifics on closing cost today and kind of how it all works. So there's a lot of confusion around it. You'll notice in some of my educational videos, I try to teach everybody in analogies. So the best analogy I can give you in this scenario is if you've ever bought a car, if you've ever bought a vehicle before, what normally happens is you go buy the car, we'll use a $20,000 car for example, and then when you go to finalize the paperwork on the car, the people at the dealership say, hey, by the way, the car is $20,000, but you've got $1,500 in tax, title, and license. So the total amount due is $21,500. So I want you to use that same analogy in today's video when you're watching this and getting educated with the auto and the tax, title, and license when it comes to buying a house. So in the mortgage business and the real estate business, the tax, title, and license version is closing cost, okay? Now where it gets a little confusing is people always try to say like, is it a percentage? Is it 1%? Is it 2%? Is it 3%? And the truth about closing cost is it's a sliding scale. It's anywhere from 2% up to 4%, and that all depends upon two big things: the price range of the home and whether or not you're including your taxes and insurance in the payment. Now I know that sounds weird. People will say, why does it matter if I include my taxes and insurance in the payment? How does it affect my closing costs? Shouldn't that just affect my payment, Brian? Well, it actually doesn't. So part one, again, is the price of the home. Anywhere from $250,000 to probably $450,000, the closing costs are about 2 to 2.5%. Anywhere from probably $500,000 to $800,000, the closing costs are probably 1.5 to 2%. And then anytime you get to like 800,000 or 900,000 or $1 million and more, it's normally only about 1 to 1.5%. And people say that doesn't make any sense. As the house gets bigger, how do the closing costs get smaller? Well, you have to understand on home loans, a lot of these third-party fees are fixed costs. So they don't move up or down with the price of the house. Now, some of the fees do, but some of the fees don't. So let me give you an example. Fairway, Brian McCauley's fee on a home loan is $1,500, okay? It's a fixed cost. It doesn't change regardless of the size of the home, and here's why. When lenders are doing paperwork and giving you a mortgage, there's a stack of paper this big. The only difference on a $500,000 loan versus a $2 million loan is not the amount of paperwork we have to do. It's just the number of zeros on the paper, right? So you have to think about it. On a $500,000 loan or a $200,000 loan, $1,500 might seem like a lot of money and eat up more of the bandwidth on the closing costs. On a $1 million loan, if we're charging you $1,500, it'll seem very minimal. So it's fees like this that are a sliding scale because again, they're fixed. And so with a smaller house, it feels like it's more. With a bigger house, it feels like it's less. The second component I want to talk about is the taxes and the insurance. So hopefully I don't confuse you here, but if you put less than 20% down on a home, you have to include taxes and insurance in your payment. It's mandated on the conventional loan. On FHA and VA, it's mandated in general, but I'm referring to conventional loans. So if you put less than 20% down, your taxes and insurance are mandated in the payment. That's an easy thing to say, hey, I've got to pay the mortgage, I've got to pay the taxes, I've got to pay the insurance, and sometimes I have to pay PMI if I put less than 20% down. That's fixed in the payment, you can't get out of it. Now, the closing cost component of that really matters because what happens is lenders require borrowers, people that are getting a home loan, to set up what's called a prepaid escrow account, okay? Prepaid escrow account. So this is how it affects the closing cost of the transaction. So what lenders are doing is they are collecting 3 months of homeowners insurance. Let's say the insurance is $200 a month. So they're gonna collect 3 months of that. So that would be $600. Let's say the property taxes are $800 a month. They're gonna also collect 3 months of that. So that's $2,400. So your prepaid escrow account that your lender is gonna require you to set up when you put your taxes and insurance into the payment is going to be an additional $3,000 on a loan of that size. The reason they do this is because historically over time, home values go up. So when you close on a home loan, your insurance is fixed, your property taxes are fixed, but it's fixed on the amount of that property when you close. A year from now, historically, that value of that home is gonna go up. As the value of the home goes up, guess what else goes up? Homeowners insurance coverage and property taxes. So the logic behind this escrow account, AKA part of your closing cost, and the reason they set that up front is because what they want to do is they want to prepare you and prepare them for the future and say, hey, if your insurance goes up $20 the next year, or your property taxes go up $50 the next year, they don't want to have to call every consumer and say, hey, by the way, John or Jane Doe, your property value went up $65,000, your insurance went up $30 a month, and your taxes went up $75 a month. We have a shortage now, and we need to chase you down every single year and get that money from you, because obviously what we collected when we started is not what it is now. So there's not enough power in the mortgage business for them to chase clients around for this shortage each and every year. So what do? They do a prepaid escrow account upfront at closing, which is part of your closing cost, and then they hold that money in closing. Now legally, that escrow account with the example I told you is $3,000. Legally, that's your money. So people say, well, what happens if I refinance or I sell the home or I pay it off before that money is used? It legally goes back to you. However, what it's used for is if there's a $3,000 escrow account that's held at closing for adjustments for taxes and insurance in the future, year 1, year 2, year 3, if there ends up being a shortage versus them chasing you down for an extra $100 or $200 or $300, they will just take from that escrow account to make up the difference. So it may reduce that escrow account from $3,000 down to $2,500 on year 1, and then maybe $2,500 down to $1,800 on year 2, and so on and so forth. So that's the reason why they do it. But what a lot of people don't know about closing costs is that prepaid escrow account is normally about 40% of the overall cost. So if you were buying a house and your closing costs were $9,000, well, $3,000 of that probably has to do with the prepaid taxes and insurance. So this is the hard part about defining closing costs on a transaction as to what it actually is. It really depends upon the specifics of the loan size, which I already explained, but it also depends upon the escrow piece. If somebody's putting down 20%, or they're doing a combination loan, or they're doing a loan that doesn't require taxes and insurance to be included in the escrow, then all of a sudden the closing costs go from $9,000 down to $6,000 because they don't have to prepay that money up front because they're not doing the escrows with the lender. So what happens is the closing costs technically are less. And when you handle your taxes and insurance outside of the mortgage and you pay them on your own, what happens is it's less on the closing costs, but you're responsible for the bills at the end of the year. So I like to tell clients it's a pay now or pay later. If you pay now and you include the taxes and the insurance in the payment and we set up the escrow account, it's gonna be a little bit more expensive, but you're not gonna be responsible for the bills at the end of the year. If you pay later, your closing costs will be less expensive by X, but of course you'll be responsible for the bills at the end of the year. So these two things really affect closing costs a lot, and this is why I want people to know how it works, why there's not a fixed answer on it, and how it can move on you depending upon the details and specifics of the client's loan. Now, I also want to transition into, well, who pays for it? Okay, so the simple answer in this equation is by design, the closing cost, just like the tax, title, and license on a car, is the responsibility of the buyer. Now, it doesn't mean the buyer has to, it just means it naturally falls on them. So you have the opportunity as a buyer to get your closing costs negotiated into the contract, paid for by the seller, paid for by the lender. There are a lot of variables that will eliminate the buyer paying for the closing cost out of pocket. But as a lender and your realtor, you don't know that in the very beginning, so you have to account for worst case scenario because we don't know exactly what can and can't be negotiated in the contract. So for example, if you're doing a $500,000 purchase price and you're putting 5% down, that would be $25,000 for the down payment. Let's use for an example, $10,000 for closing costs because you have your closing costs and your prepaid escrow and everything that I just discussed. So your total as a buyer to get to the finish line is going to be $35,000 total. That's $25,000 for the down payment, the 5%, and that's $10,000 for the closing costs. So when I pre-approve clients, I have to put together a total cost analysis and scenarios for clients, assuming the worst case scenario, because those closing costs are really the responsibility of the buyer. However, this is where the fun part starts. So we all know going into the transaction when somebody's pre-approved, that worst case scenario, the buyer has to pay for those costs. So we prepare ourselves for the $35,000. But when I'm talking to clients and I'm talking to my realtor partners out there, we like to give suggestions because closing costs are always one of three things for every buyer in one of these three categories. So the three categories are: if they're trying to negotiate it into the contract and the client does not have the money for the closing cost, we have to tell the realtor, hey, number one, you have to get the closing cost included in the contract. It's mandated, meaning the client doesn't actually have $35,000. All they have is $25,000 for the down payment. So if they don't have that $10,000, the realtor has to get it negotiated into the contract. So number one is mandated, okay? Number two is strongly preferred. What that means is, hey, the buyer actually has the $35,000, the $25,000 for the down payment, and the $10,000 for the closing costs, but they strongly prefer to try to get those closing costs rolled into or negotiated into the contract and paid for by the seller because they want to keep that $10,000 in their pocket, in their bank for safety, for security, for whatever reason, but they can pay it. They just strongly prefer that it be in the contract if it's negotiable, okay? And then number three is not needed. So not needed is, hey, this person has plenty of cash, they can pay for everything, down payment, closing costs on their own. Mr. or Mrs. Realtor, don't even make it a negotiating tactic in the contract because it's not needed. So part of that equation with the closing cost is when I'm doing the financial strategy session and mortgage planning session with clients, I have to know what's most important to you. Where's your payment? How much cash do you have? Because if they don't have the cash, I have to huddle up with the realtor and say, hey, you can't make an offer on that house unless you can get these closing costs mandated in the contract because the client just doesn't have it, or strongly preferred, or obviously not needed. So it's a big component to home loans. This is how closing costs work. They stay pretty similar in nature as far as cost specific to each loan. So a $500,000 conventional loan, a $500,000 VA loan, a $500,000 FHA loan, the closing costs are pretty much the same on each. They may vary by a couple $100 here and there, but for the most part, they don't change shape or they don't change the dollar amount overall, so it stays pretty consistent. But as I explained before, it's a little bit of a sliding scale. So again, the escrow piece and the taxes and the insurance is a big piece. Because, you know, it affects the bottom line a ton. It's about 30 or 40% of the overall closing cost, and people don't account for this and they want to understand why. Now, of course, when I release pre-approvals, we release total cost analysis to all clients. There's a closing cost tab. People can click on it and see exactly what the total is and how I got there, right? But this is just topic for discussion during the transaction. So for everyone out there that's wondering, what are closing costs? How much is it and how does it work and who pays for it? Now you know. It's a sliding scale. It can be a negotiating tactic with the realtor and with the seller if they can manage to do it. In a market like we've got right now, sellers are willing to negotiate. They're willing to listen. They're willing to help with offers. They're willing to help and pay some or sometimes all of the closing costs. But my belief is that window won't last forever. And depending upon how hot the market gets, you and your realtor have to figure out that strategy once you go to the marketplace. So that's a little closing cost 101, and hopefully it helped. So listen, I hope you found this video useful and helpful. If you did, do me a favor, like, comment, subscribe. If you know somebody that needs this information, share it with them. And if you want to set up a consultation with me just to talk about your future homeownership journey, have financial questions, or want to get plugged in to get a pre-approval, call us, email us, text us. We're always here for you. Until next time, stay tuned.